Hello everyone and welcome here. We're going to be talking about depreciation, and when we say depreciation, we're going to be talking about this with respect to calculating taxable income. So the objectives of this module is to calculate depreciation and book value of an investment using common depreciation methods. And here you're seeing some technical terms such as book value. We're going to be talking about those technical terminologies, and we will be learning about how to apply depreciation to establish after-tax cash flow. And that is the main objective that we're pursuing here. We want to be able to establish after-tax cash flow and calculate financial performance after tax. So let's get started here. Why does depreciation matter really? Well, corporates pay income taxes based on their taxable income, not based on their gross income. Well, you may ask, what is the difference between them? Well, the difference is taxable income is gross income minus deductions. And the deductions are what we were going to talk about here. Deductions, there are different forms of deductions, and one of them is depreciation. The other one is business expenses, but all of these are deductible from your gross income. So you essentially can decrease your taxable income by using more deductions, and depreciation is an opportunity here. You can use a depreciation of the assets that a business bought to reduce their gross income and have a lower taxable income and pay less taxes. And that's the ultimate goal here. So let's take a look at one example to clarify this a little bit more. Here it says, how much do each of the companies below pay, assuming the tax rate is 35%? Well, we're given the gross income and we're given the expenses for each one of them. We need to find the taxable income and then apply the 35% tax on that. So let's go ahead and do that. Here is the gross income, $300,000, and the expenses is $200,000. Therefore, taxable income is the difference, is $100,000. Now, given the taxable income of $100,000, this company is going to pay 35% tax. That means the income tax is going to be $100,000 times 35%, and that is $35,000. That's going to be the tax amount that this company will pay. So now if you look at the tax that this company ended up paying and compare it to the gross income, which was $300,000, it's a little over 10%. And this is called the effective tax rate. The effective tax rate for this company was a little over 10%. But the tax rate or tax bracket for this company was 35%. Because of the deductions that they were able to use, they ended up paying a lot less than 35% on their income. Now let's take a look at company B. We have a gross income of $300,000, and the expenses is a little less than company A. So we can say that the taxable income for company B is going to be larger. It's going to be $300,000 minus $175,000, which is $125,000. Now, $125,000 is going to be subjected to 35% tax rate, so the income tax is going to be $125,000 times 35%. And if you do the math here, that is $43,750. And that is larger than the income tax that company A ended up paying. And that's only because the difference in their expenses or in their deductions. So you can clearly see that depreciation is helping businesses paying less taxes because the government put in place depreciation as an incentive for companies to grow their businesses.